Behind every purchase order, receipt, or inventory transfer lies a critical process, that is cost accounting. In Oracle ERP, this process ensures that your business transactions are translated into precise financial entries. It's a sequence of programs designed to validate, cost, and distribute your transactions. Today, we will walk through each of these programs step by step, and you will learn how they work together to deliver reliable cost accounting distributions. Welcome to our overview of cost accounting distributions in Oracle ERP. Today we will explore the structured sequence that ensures your inventory, manufacturing, and procurement transactions are correctly valued for and accounted. The transfer programs are the foundation. The process begins with three essential transfer programs that move the cost information between the modules. First is the receiving program that transfers the data from the receiving module to the costing module. This handles the initial step when the stock is received at your location. Second, we transfer the inventory transactions data to costing. This specifically addresses the transactions where the stock is delivered to the sub-inventory and the second step in your supply chain process. The third is the payables to costing transfer, a finance program that handles the transaction like invoice price variance or IPV. This ensures that the difference between the purchase order prices and the actual invoice amounts are correctly accounted for. Next is loading the costs, that is building your cost foundation. Once the transfers are complete, we move to the cost loading through the manage cost scenario task. You can think of it as creating a cost simulation just as we used to do in EBS R12. Here is what happens. You will create a cost scenario and select your cost organization and cost book. And this is critical that you have to specify the cost effective date here. This date determines exactly when your item becomes active. You can enter the costs manually or upload them using ADFDI. The system handles the various cost elements, including the material costs and overhead elements. And once your costs are entered, we will run the update standard costs. This will change your scenario status from new to published. Next, we move on to the distributions program. We have two main distributions program. One is receipt accounting distributions. This is run from the receipt accounting area. It processes the receiving transactions and creates the necessary accounting distributions for stock receipts. Next is cost accounting distributions. When you run CAD for the first time, you will define the system parameters, including the cost organization, cost book, and a crucial cutoff date. This determines how far back the system processes the transaction. CAD handles all the transactions in inventory, which includes the sub-inventory transfer, inter-organizational transfer, movement requests, miscellaneous issues or receipts, cycle count adjustment, or physical count adjustment. It also processes the manufacturing transactions. There are certain critical considerations which has to be handled carefully. One of the most significant problem occurs with the incorrect cost effective date. If the transactions happened, for example, in May 2025, but you loaded the cost with an effective date of June 1st, the system cannot cost those May transactions, and this will show as costing not processed. Once the cost scenario is published with the specific and the basic date, you cannot load the cost with an earlier date transactions or easily undo the rule. Debit what comes in and credit what goes out. This dual entry system governs all the inventory movements. Miscellaneous receipts increase the unknown inventory, debit inventory valuation, and credit the offset account. Miscellaneous issues decrease to unknown destinations, so credit inventory valuation happens and debit of offset account happens. The system tracks the stock origins through depletion layers. Transfer and adjustments. The sub-inventory transfer generates two transactions: source location, credit inventory and offset account as the stock leaves, and destination debits the inventory and credits the offset as the stock arrives. Count adjustments handle the discrepancies. The positive adjustments debit the inventory and credit the offset, and the negative adjustments do the reverse. Inter-organization transfer uses the trade-in transit valuation. Source credits the inventory and debits the trade in transit. Destination debits the inventory and credits the trade in transit. Order management and purchasing. Order entry and booking create no entries, but order picking follows the sub-inventory transfer rules. At shipping, the inventory valuation is credited, but modern Oracle debit Deferred COGS account, not immediate the COGS, cost of goods sold account. Only after the customer acceptance does the real COGS entry occur. It debits the COGS and credits the deferred COGS. This aligns with the GAAP revenue recognition principles. Purchasing. Requisition and PO creates no entries. At receiving, debits the receiving account and credits the accrual account. At delivery to inventory, debits the inventory valuation and credits the receiving account. The key distinction to remember is PO receiving falls under the receipt accounting, and anything that touches the inventory falls under the cost management. Every transaction maintains the fundamental principle, that is, debit what comes in and credit what goes out, ensuring accurate inventory valuation and financial reporting.